Hey guys, welcome back. Today we're going to talk all about investing made simple, and this is part 2 in the series. So if you're just joining us, go back and watch part 1 and then come back and we'll break it all down with you. And so today we're really going to be breaking down what is a stock, what is a bond, going back to the basics, using some Shark Tank analogies to understand how we think about that. Then we want to talk about how do we understand risk in a portfolio and what does that actually even mean? And then how do we apply that to what types of investing, how aggressive should we be for different goals in our plan. And so as we stick around, what they're going to talk about, we actually have a great resource that we're going to use to actually visualize, and we actually backdated all these different types of portfolios to see how we would have been invested over different intervals throughout history. So some cool data to go look at, because we always want to be making sure we're making decisions based off of data and not based off of a feeling. It's always nice to go off of that. But if it's your first time joining us, welcome. My name is Michael Foley. I'm a certified financial planner and a certified student loan professional. And I'm also the son of 2 doctors, and I really developed a lifestyle creep for our healthcare workers in our society. And we really want this to be a place where we can simplify the complex world of finances and really help to ground you and get more intentional in your finances. So excited to come alongside you in this, and let's dive in. When we first start talking about investing, we really want to be thinking of, okay, what is a stock? What is a bond? A lot of people think, okay, stocks are more risky, bonds are more conservative. That's pretty much the extent of what I know, right? So let me take you back, and if you've seen Shark Tank, it's a great show on TV where companies will come in and they'll pitch their business, and then the judges will offer to buy a stake in their business or do different deals with them, right? So it's a great analogy for us to be thinking about investing, okay? Let's say in a scenario where a company comes in and says, I want $100,000 for 10% stake in my company. Will any of you guys give me a deal, okay? So let's say Mark Cuban is one of the judges that will often give an offer, and they'll say, yep, I'll give you $100K and I'm going to take 10% stock ownership in your business. So Mark in that scenario just bought 10% stock ownership in that business, meaning that stock in that business. So when we buy a share of Apple, a stock in Apple, we're a part owner in Apple. So yes, you can consider yourself a part owner. It's maybe a very small part owner, but an owner nonetheless. So that's a stock, okay? Now, Mr. Wonderful, one of the other judges, oftentimes it makes a little bit different deal. And so what he'll say he'll say, I'll give you the 100,000, but I don't want any stake in your company. I don't want any stock in your company. But instead, I'm going to charge you 15% interest, and I want that money back over a 5-year period of time, okay? So what he just created was a loan to that business that we call a bond. So a bond is simply just a loan to a business, to maybe the city that you're living in, the government. That's all a bond is, right? So when we look at how do we take that information of what a stock and what a bond is and relate that to risk, right? So a lot of people think of risk as what is the risk of the company going out of business, right? But in that situation, let's say Mark and Mr. Wonderful both have an equal likelihood of losing their money in that situation, right? That business could go out of business and they could both lose their $100,000 in either situation. So that's not a good determinator of risk, because let's say instead of investing in just that one company, what if they invested in 2 companies? They just halved their risk of one of those companies going out of business, right? We can really do that times 100, times 1,000. We can almost neutralize the risk of one of those companies going out of business, right? And so what that allows us to do is to diversify that risk away. So then that's not a good way of looking at how should we be managing our investments. If we know that we can be properly diversified, we can manage that risk. But now the question is, when are they going to get paid, and how much are you going to get paid in that situation? So Mark Cuban, when he buys stock ownership in that plan, in that business, he has no idea when that company's going to go up in value. He might be able to add influence to help them get other deals or different contracts to hopefully have the value of the business go up over time, where then his ownership in that business goes up in value, so he's making money. But he doesn't know exactly when that's going to be, but there's a really high potential because that business could grow exceptionally large, and his little share in that business could also grow during that. Whereas Mr. Wonderful, when he has a bond with that company or a loan to that company, it's a lot more stable because he knows he's getting that 15% over the next 5 years as long as they don't go out of business, right? So it's a lot more stable throughout, but it's capped at how high how much he can actually make on that investment, right? He's not going to make more than 15% on that deal. And so it's less risky in the fact that we have a little bit more predictable stability with our income and when that's going to be coming in, but we're not going to have the same type of long-term performance that we might with a stock. But the stock is going to have a lot more volatility so the worth of the company is going to go up and down over time, and so that's to be expected. But over the long term, the more volatility and the more that we are invested in stocks, hopefully we're going to be actually yielding more return. So you might have heard the saying, the more risk, the more reward that you should be getting. So if we're defining risk in that sense of how volatile is your portfolio going to be, or aka how much stock do you have in your business, in your portfolio, then that's going to be a better determiner of long-term performance than any other depictor of risk. So let's look at what types of portfolios and how, if this is true, right, the more stock, the more risk, which means the more reward, then that should mean that our profile sits here should be our highest performing portfolio. And so what this is, our investment platform here, and this actually breaks down different profiles. So this is our most conservative profile that only has 20% in stocks and the rest in bonds and cash, all the way up to profile 6 is our most aggressive 100% stocks and everything in between. So if what we just talked about is true, we should see this should have been our hands down the highest performer throughout history, and this should be our lowest performer, and this should be exactly in that order. So that's what we did. So let's check it out. Let's actually look at the data here. So we actually backtested and said if we had a diversified portfolio with this breakdown of stocks versus bonds over these different time frames, how would it have performed? And as expected, profile 6 here performed categorically the best throughout history. So it won all the way through. If you invested from 1926 to now, you would have had the most performance out of our profile 6, then 5, then 4, then 3, then 2, then 1, exactly in that order. So this is modern portfolio theory. This is actually research data driven to show us exactly how those are performed. So you might say, why don't we just throw it all in a profile 6, and just because that's clearly our best performing fund. That's what a lot of people will come to us and say, hey, how much rate of return can you get me? And so that's how much I want to put all of my money as aggressive as I can be in your highest to highest performing fund. That would categorically be our profile 6, but my follow-up question would be, how long do you have to invest in it? Because that's going to change our probability of a successful outcome for you. Because let's look at 2008 here. So let's say you invested $100,000. You said, Michael, I love you. Let's give you $100,000. Let's have you invest that. I want you to put it in our most aggressive, your best performing fund over the long term. And so that would be a profile 6. But let's say they decided that they needed that money in 2009. If we would have invested that in that profile 6, in 2009, that was a huge drop. So I don't know if you did appreciate how big of a drop that was, but that was probably close to 30-40%, right? So if that person was needing that money in their plan, they were maybe counting on 100,000 or if not more, hopefully if it would have grown over that year, but they actually ended up having maybe $60,000 or $70,000 in the account after that 1 year. So if your goal was in the 1 year time frame, gosh, I really would have rather you been in like a profile 1 here that would have actually gone up during that time frame from 2008 to 2009. That would have been a better fit for your plan, regardless of the long-term performance of the profile 6. So as you can see, it really depends on how long do we have to invest, and then that's going to shape how aggressive we can be in our overall investments. And so if you look at it in profile 6 over a 30-year time frame, there has never been a negative 30-year time frame for a well-diversified all equities portfolio. The lowest time frame ever throughout history was during the Great Depression, and it still did 8.94% year after year for 30 years, right? So it crushed it. But let's zoom in for a second on this is the same portfolio, but let's zoom in on a 1 year basis. So let's just say In 1929, you wanted to be the savvy investor coming off a strong year, and you gave me $100,000 to start investing. You said, I wanted a profile 6. I have 30 years to invest. I know now that I need to be long-term focused and need to be thoughtful of, I'm not going to need to touch this because it's too high risk in the short term, but so I'm going to just let this cook. But so year one, you put the $100,000 in. Year one, it drops 18.9%. So now we got like $82,000 in the account. And then you're like, Michael, I love you, but I don't know. This is not a great start to our relationship. Now, year two drops another almost 30%, like 27.7%. So now we got like 50 grand, a little over 50 grand in the account. That just 2 years prior, you got $100,000 that you gave me. Not great. And then if you haven't pulled out of the market at that point or fired me at that point, right, this is when most people will say, all right, look, we got another negative 44% in the account. We got like 40 grand in the account at that point. This is ridiculous. And so where's the bottom? Like, I gave $100,000 3 years ago. I love you, but you're terrible at your job. You clearly don't know what the heck you're doing with this. So we're gonna pull out of the market. We're gonna get out. So that's when most people get out of the market. And then if they're not out of the market, they're definitely out on another negative 7% run there. And then most people miss out on the positive 75% growth that next year. And then it's followed by a 5% growth, and then another 44% growth, and then another 41% growth. And then this is when we get fired again, another 40% drop, right? And so as you can see, it is a roller coaster of emotions, but over the long term, you can see this is the same portfolio that yielded these results over the long term. So you got to be thoughtful of what is the time frame that we have. But if we are going to be investing aggressively for the long term, we almost got to put our blinders up and just let this thing run, right? But if we're going to need the funds over a more condensed time frame, so let's say maybe we're investing as a backup plan for the PSLF program. We often see that as a goal for a lot of our clients. So let's say you finished residency, we got 5 years that we're saving until we get the forgiveness on our public service loan forgiveness program, let's just say, for example, and we want to have a hedge. I don't love the outlook of our profile 6 here. I probably would want to be a lot more conservative with maybe like a profile 2 or profile 3 here, that even in a profile 3, the worst possible scenario was a negative 2.32% year after year for 5 years, which is it's not great, but it's not a negative 40% drop like in a profile 6, right? But hopefully we're yielding a little bit higher than what we would get in a high yield savings account, right? Over that time frame, and getting a little bit better tax treatment for any of the stock exposure as well. So that's something that we want to be really thinking about, our investing in the context of how long do we have to invest. And the longer that we have to invest, the more aggressive we can be, meaning the more equity exposure we can have or stock exposure we can have in our portfolio. And the shorter the time frame that we're investing, the more conservative that we need to be. Anything under maybe a 3-year time frame, that should honestly be in cash. We can't really take any risk on that because we don't know what's going to happen in the market in the short term, and it's best suited to probably have that more conservative if we're going to have that goal in the next year or two. But anything past that, we can slowly, incrementally increase our aggressiveness. So this is why it's so important that within those different accounts that we talked about in the last time, if we can actually set up individual buckets, we can set up specific goals. So maybe some of our clients might have a retirement goal in their taxable account that we can have in a profile 6, but then maybe we also want to put funds into that same account but earmark that for student loan backup plan that maybe we want in a profile 3, and we earmark that one as the student loan backup plan. That's the nice thing, is that we can actually set up different portfolios for each of those specific goals, because any money going in your investment account should have a purpose. If you're investing and you don't know why you're investing or why you're saving, that is a perfect recipe for burnout. And so we do not want to see folks doing that. We want to make sure that we have a clear identified purpose, not only because of the psychological benefits of knowing what you're saving for so we don't lose the energy in actually pursuing that, but we also need to know how aggressive can we be in our plan, because the goal in our finances is not to try to get the most rate of return. The goal in our finances is to try to take the least amount of risk to get what we need out of our investments in the plan, aka get the most life out of your money. It's not necessarily the most rate of return out of your money. So thanks so much for joining us today. Hopefully this has been a helpful breakdown of the different options that you have when you're looking at investing, help simplify the complex of this world. So we'd love to come alongside you. So if you're starting into your investing journey or have maybe a more experienced investor and we want some more kind of home-based, data-driven portfolios in your plan, we'd love to come alongside you and sit down and meet with you and maybe evaluate how you're investing currently and then help offer some additional suggestions of how we might want to do that moving forward as well. So happy to meet with you and come alongside you and your family. So looking forward to meeting you, and we'll see you in the next episode.